Some influencers are calling this gold bounce a rocket launch, but I think we were just stuck in a directionless range for now. There's too much noise out there, and honestly, any hard prediction right now is just pure guesswork. Yesterday, gold reclaimed the 4,500 level. If we had to credit this mini rally, it came down to two major assists. First, a smooth PCE print, and second, the CME's surprise cut to gold and silver margin requirements. The freshly released PCE deflator came in dead on expectations, no nasty surprises, no black swans. Since the inflation narrative didn't get any worse, the market has fully priced in the data. And right after that, the CME slash margins for gold and silver, lowering the barrier instantly relieves capital pressure and transaction costs. Combined with the sell the rumor by the fact relief from the PCE, this directly fueled the bounce. But why is a margin cut actually bullish? First, the same amount of capital can now leverage larger positions. This naturally lures retail money and high-risk traders back in to buy the deep and chase the leverage play. And second, it brings back the speculate arbitrate players. Lower margins drastically cut carrying costs for gold and silver ratio trade, enticing quant funds and RBAS back into the market to inject liquidity. But there's a bigger reason. The prerequisite for any margin cut is that the CME's risk models show intraday volatility for gold and silver has cooled down significantly. The exchange now believes the risk of consecutive extreme gaps has faded, so they don't need massive margin cushions to guard against clearer defaults. This signals that the speculate frenzy and panic liquidations are likely behind us. The market is now highly likely transitioning into a more rational range-bound consolidation phase. However, this is definitely not a cue for the bulls to pop the champagne. Let's take over at our tip. Chevron CEO just warned that due to the situation in Iran, crude inventories are steadily draining and oil is highly likely to grind higher over the next 2 months, especially heading into July. Let's look at this from another tactical angle. If you analyze this sluggish tape, have you noticed that over the last 2 months, every time oil peaks, gold's subsequent bounce gets shallower? For instance, on April 17th, oil crashed and gold managed to reap up to near 4,900. And on May 6th, oil flushed again, but gold really only taped the 4,700 handle. And after this week's oil drop, gold is barely scrapping back above 4,500 today. Why are the peaks of this gold rally getting lower and lower? A key reason in my reel is a shift in institutional appetite. In my past, an oil crash would shift inflation and safe haven expectations, easily triggering a massive bid in gold. But today, the macro reality of a restrictive high interest rate environment is just too heavy. So even if oil dumps without a concrete rate cut catalyst, smart money is refusing to trigger a major upward run. In the short term, bearing any sudden black swan headlines, gold is stuck in a choppy, directionless range. To sum it up, PCE and margin cuts have put a temporary floor under precious metals, but those lower highs are keeping a very tight lid on the upside. Okay, lastly, a quick word on silver. As we discussed, industrial demand for silver is being suppressed, and without the structural support for central bank buying, its fundamentals are weaker and harder to speculate. HSBC just released a note predicting that the gold to silver ratio is set to widen further. We might see a clear divergence between silver and gold. In other words, silver might establish its directional trend first, though it will still mimic gold's moves in a very near term. Okay, as always, this is just my personal trend analysis, not financial advice. And also, shout out to EBC Financial Group for sponsoring the content.